Hey all, welcome to ShareTreck. Today I'm sitting on the other side of the screen for a change. It's the 6th of January, it's almost 9 p.m. and I thought I'll make this video to share my thoughts with you about what's happening in the market and where we are today and what's going to happen next. So once again, let me remind you, these are my personal opinions and this is not financial advice. Please do your own due diligence before you make any investment decisions. So having said that, let's take a deep dive into why we are where we are today. And it all starts with the Fed Reserves and the activity taken by the actions taken by the Federal Reserve. The first thing they did was they told us that the inflation that we are experiencing is transitionary. And that story maintained for a while because we had supply chain shortages, travel embargoes, and everything due to the pandemic. And it was believed that once the pandemic is gone and under control, the inflation will go away. That's why the statement that it's a transitionary inflation was made. And then later on, the Fed came recently to say possibly it's not transitory after all. So the first time it was mentioned was during a hearing with the Congress when Fed Chairman Jerome Powell made that statement. That sent a bit of a flutter around the markets, but it didn't do too much to dampen the spirits. And later on, today we saw the Fed minutes which were released, and it seems to be much more hawkish than people thought. And that's the reason why the market got spooked. The perception after reading the Fed minutes was that the tapering has been hastened. It is going to happen much faster than before. The second thing is that earlier we thought once the tapering is completed, then the interest rate hikes will start. Now the feeling is that they may start back to back or maybe even overlap. So that is the other feeling I believe the market has. And the third is that possibly there will be more hikes than were previously thought. So these are all the factors which kind of cause the market to fall down. Now, we may say, what does this have to do with the markets? So the thing is, it was inevitable that after having a 2 trillion tax cut in the previous administration without adequate spending cuts, we would have printed a whole lot of dollar bills in order to bridge the deficit. And that was done by increasing the debt ceiling when the new administration came in. So they paid the debts of the previous administration. So that was one part of printing more dollars. The second part is the 1.2 trillion infrastructure package that was already approved and which is likely to start getting into the market very soon. The spendings will start happening, and that's going to pump in 1.2 trillion dollars into the economy. And these are going to be brand new dollars. They are yet to be printed. They will come in the next debt ceiling hike. And then waiting in the wings is a 1.5 trillion Build Back Better package that is currently undergoing a lot of struggle to be passed, but eventually it will be passed in one form or the other, and maybe it will have at least 1 trillion or maybe 950 billion pumped into the economy once again. So these are all the things that are happening which are pushing more and more dollars into the economy. And the effect is that there are too many dollars chasing too few assets. And one of the asset classes that they are chasing is the shares. So share prices are going up. The other asset class they are chasing is consumables. So consumable prices are going up. They are chasing homes. So home prices are going up. And this is what is called inflation, where the value of the fiat currency goes down. Therefore, you need more of the currency to buy the same amount of goods. The pandemic cycles kind of caused problems for the supply chain and they led to shortage, and that was the first layer of inflation that came in. And along with the pandemic, we had lockdowns, right? And so we gave subsidies, the government gave subsidies to compensate for the lockdown. And anytime when you have cash without work, that means nothing has been produced, but money has been given. That means as good as printing dollars. So that again is inflationary in nature. And finally, the shortage of workers, the tight labor, higher production cost, all these are leading to inflation. So as wages go up, the bottom lines of companies go down, and they have no option but to pass on at least a part of that to the end consumer. Therefore, the prices go up. And why do stocks drop on inflation, right? The stocks drop on inflation because interest rates are hiked to combat inflation. So when too many dollars are chasing too few assets, one of the tools that the government has in their hands is to raise the interest rate and make borrowing money expensive. As a result, whoever is borrowing money is going to look at where they are going to deploy the money and what kind of returns they are going to get from it. So as the difference between the return and the cost of capital starts decreasing, less and less ventures take place, and therefore less and less money gets spent and more gets saved. And that's how inflation is kind of tempered a bit. Effectively, the stocks drop because future income is getting discounted by the inflation rate. So a dollar today is not going to be worth the same 1 year down the line, because if the interest rate is, let us say, 1.5% or maybe 1%, so a dollar today is worth $99 at the end of the year. So if an income of $1 is coming at the end of the year, investors are going to look at it as 99 cents and not a dollar. So that's how the impact of interest rate hike is felt on shares. So what would happen is that not all companies will drop equally. Companies which are cash rich and which are dividend paying and established in their business and are in a position to command the price for their product will drop less. So companies that come to my mind are companies like Apple and Microsoft, these kind of companies which have got huge cash piles, and they also have very established products with a streamlined distribution system, and which are well established in the consumer's mind and which command a premium, and which the customers will be willing to pay. Those kind of companies will not drop. They will drop, but they will not drop as heavily as other companies. And the kind of companies that will drop the most are non-revenue generating companies and risky companies. Non-revenue generating companies are some companies which are either in the cutting edge of technology and they're in the process of developing a product that is going to be monetized, and it will start a revenue stream, but presently they don't have any, and it's all venture capital money and shareholders, patient shareholders who are waiting for things to happen. Those kind of companies are going to take a hit. The companies that do not pay a dividend, the companies that are unable to guarantee that they will have a product that will generate a revenue stream, those kind of companies are going to take a hit. Markets will revert back to price by equity multiples as opposed to price by sales, because right now in the market we have been seeing price to sales multiples being used, and there was very, very rich valuation for many companies. Some companies that come to mind are like Shopify, and you had Fiverr, those kind of companies. They are all going to face a lot of problems, because now investors are going to look at price to sales multiples, and that too, they won't have high multiples, because as I explained earlier, a dollar earned at the end of the year is 99 cents as of today. So that's something that we have to keep in mind. Market values sales at a lower multiple due to inherent depreciation of future earnings by the interest rate. So that's what I meant with that 99-cent analogy. There are some contrarian opinions. So one of the most contrarian opinion is from Kathy Woods, who believes that there is going to be a deflation. And when I listen to her, I do feel that she has a point, because she's saying we are developing some technologies which are going to be so effective in generating productivity that it will help towards deflation instead of inflation. So instead of telling the whole thing by myself, let me cue up the tape. Please have a listen, and I'll meet you on the other side of the tape.
They will be focused on monetary policy when they say that. I am a student of economic history, and I've lived quite a bit of it myself, so seen a lot of markets, and started in the business during the 70s. I was in college when inflation was raging. So I know what that is, and I truly believe we are not going back there, and that anyone planning for it is probably going to be making some mistakes. So the three sources of deflation that we see, to go into a little more detail, on the innovation side, technologically enabled innovation, we are in a period today like we have never been, never. I mean, you have to go back to telephone, electricity, and automobile to see three major technologically enabled sources of innovation evolving at the same time. Today we have five platforms: DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, all of which are deflationary. And not just by a little bit either. Jeff Gundlach and Howard Marks, and I think Stan Druckenmiller, and Ray Dalio, all of them, I think, have been very, very concerned about a deflationary bust. And we agree with them in this respect. We think it's going to be balanced by a deflationary boom. So that's where we differ. But where we agree is that there are companies who thought the world would never change and have been, again, catering to short-term shareholders who wanted that extra penny or two in earnings, and so got it by having the companies leverage up and take more debt and shrink the number of shares. And they've also been focused on dividends. They are probably saddled with products and services that will become obsolete because of the record-breaking amount of innovation taking place today. And in order to service their debt, they are going to have to cut prices and move those goods and services that are on their way out anyway. So I am concerned about that, and I think there's going to be a lot of confusion around it as well. So that's why we keep our eye on the innovation ball, because that is going to balance these issues out to a great extent. Our company in 2014, Oxford University had just put out a piece which said, and it was about the United States, that said 47% of all jobs in the United States would be lost to automation and artificial intelligence by 2035. And they left it there. Hair on fire, headlines screaming, a lot of fear about automation. We got the question every meeting. And what they had neglected to do, which we did, was finish the story. So with automation and artificial intelligence, productivity is going to go up dramatically. We think more than it ever has, certainly in modern times. And with productivity increases comes more wealth creation and more GDP creation. And according to our estimates, in the year 2035, because of automation and artificial intelligence, we believe that GDP here in the United States will not be 28 trillion, which would be, if you drew the growth, linear growth, that's where it would be, but instead will be $40 trillion. And it is our job, focused only on innovation, to figure out where that extra $12 trillion is going to come from, and then to educate and orient our investors, of course, but also parents and grandparents. You know, how should you educate your...
So as you saw in the last clip, right, there are quite a few valid points. So basically, when I was talking about dollars being printed without work being done, that's what deflates the currency, and that reduces the value of the currency and creates inflation. So if you have these technologies like automation and robotics and all this put together, and AI, and if they are able to create super productivity, then whatever dollars we have printed now are not going to have much of an impact, because the productivity is going to be so high. If you're talking about a 12 trillion extra, that is phenomenal. So that's where Cathie Woods is coming from. And it's very difficult in real time to estimate what is going to happen. When you look back, hindsight is 2020. So that being the case, we are in very interesting times. Whether Cathie Wood is going to be right, in which case all our CRISPR shares are going to do extremely well. However, if Cathie Woods is wrong, and if the traditional economic thinking prevails, then the dollar would have been made very weak. And as a result, things are going to look quite bleak indeed. Now, what is likely to happen to the CRISPR stocks, right? So all CRISPR stocks, except established big pharma, like the kinds that we have, like Novartis and the like, which we have included in our small list of CRISPR share that we are tracking. Novartis would not have so much of a problem, neither would Pfizer, because they already have a whole lot of products and patents in their under their belt, and they have revenue streams in place. But companies such as Vertex and CRISPR will do well if they monetize sickle cell therapy by the third quarter of this year. So if we can get news that they are very close to monetizing, say somewhere around June, their shares may pick up, with the anticipation that probably in the last quarter of the year the monetization may happen, and after that it will be just way up, because the kind of products that they are coming with, it's a lifelong cure for sickle cell anemia. So a lot of governments may decide to offer that therapy to their citizens, and it might be covered by the government. And because if, from a government's point of view, if that treatment is given to their citizens who are suffering from those ailments, then the other medical costs that the government will have to bear will go down, and the cost to the government will be very less by offering these treatments. And as the number of patients being treated grows, the cost per treatment will be reduced, and so on and so forth. The economies of scales will come into play. So I have great hopes for Vertex and CRISPR Therapeutics. There might be some other companies also, like Beam or Editas or someone, who have got some candidates in a very advanced stage. We'll have to wait and see. If more than one company ends up with sickle cell therapy, then the pie is going to be divided among them. So we may get a slight reprieve if Omicron is the last wave and there are no more variants, and the whole pandemic kind of ends as expected in the last week of January, in which case we'll get a bit of a reprieve, because a lot of travel that has been put on the hold will get started. The hospitality industry will start to do better. The theater, the hotels and the restaurants, all of them will be back into business. Cruises will get back. The theme parks will get started. Theater will do well. All those things, they are all additional to the GDP and employment. So things will start looking better. But on the other hand, if we go with the traditional economics, if things are starting to get better, that means the inflation is going to rage even more. So the interest rate hikes will have to come into place in order to temper it down. So it's a very confusing time, and that's why you see the volatility in the market, because people are going through all these, investors are going through all these kind of possibilities, and they're trying to make up their mind. So I bet that after you see this segment today, you yourself will be thinking in different ways, and you will have different ideas in your mind, but you would not know for sure which is the right thing to do. So that's why the market has the volatility that we see today. And when the market is highly volatile, the indices do fall, and shares and cash migrates towards safer stocks, which are cash rich and which are dividend paying and with a very, very solid consumer base. So we may get a boost for core sector if infrastructure bill spendings occur. The $1.2 billion infrastructure spending can do very good for the likes of Caterpillar and the other companies which supply aggregates and steel and building materials, because a lot of highways and roads are going to be built, and earth moving material, concrete, and like Vulcan is another company that comes to mind. So concrete, steel rebars, and heavy earth moving equipment, all these things will get a big demand, and those companies will start faring better. And in terms of what exactly may happen to the other industries, I have one more point there. If Build Back Better gets passed, it has got a big chunk of money for incentives to promote EV adoption. So if it gets passed with that particular provision, then electronic vehicles and electrical vehicles and solar cells and all those kind of technologies might get a boost, and that would be a shot in the arm for the stock market. So these are some of the things, positive things that are likely to happen in 2022. On a more philosophical note, I would pose the question, should so much more dollars be printed, right? Because at the end of the day, the dollar is just a promise of the government to pay value. Earlier, the dollar was backed by gold. So every dollar that was printed was backed by gold, and the value of the dollar was derived by gold. And since Nixon delinked the dollars from gold by saying that no one can demand gold in exchange of dollar from the government, what has happened is that we have been printing dollars with every debt ceiling being lifted, and there are so many dollars, and the only reason why things have not been hyperinflationary is because the dollar is a reserve currency and it's used all over the world. But sooner rather than later, many countries will start questioning whether their national reserve kept in dollar denominated funds are going to hold the value, in which case people will start gravitating towards gold. So I'm expecting that in the next few months, 6 or 7 months, there will be an increase in the price of gold. However, if Cathy Woods is right, then things can go entirely different. So you can see the challenge here to predict how the market is going to go. So that is what I have for you today. And with that, I'm going to leave you to think about what I have mentioned, do your own research, and put some things in the comment so that we could have a discussion. I thought I would record this special segment. It's a bit longish, but I wanted to give you a background of what is in my mind when I'm looking at the VIX and the NASDAQ indices and the CRISPR shares, and then I'm looking at the technical analysis. The technical analysis basically is a very short-term use for swing trading and day trading. But from a fundamental point of view, we have to look at the macroeconomics and the forces that are at play. And I thought that it would be important for you as a CRISPR investor to understand clearly where CRISPR stands if the traditional economic thinking were to prevail, and where it stands if what Cathy Wood says comes true. Because if what she says comes true, then we are in for gangbuster returns on all the CRISPR shares. Whereas if she's wrong and the traditional economic sense prevails, then we are going to go through a period of pain before we see any gains. So once again, I would say one of the best strategies would be, first of all, dollar cost average. If you have high conviction in any stocks, as the price goes down, invest little by little, not all your money, but little by little, to reduce the dollar cost of your holdings, because you don't know how low it's going to fall. So always have something to buy when it's lower. That's one strategy I have in mind. Again, these are all my personal opinions and not investment advice. Please consult your financial advisor before taking any investment decisions. The other thing I generally do in this kind of a situation is I look at all my beaten up stocks which have been performing poorly, the dogs of my portfolio. And when situations like these happen, I get rid of them, book the losses, and put the money into really promising sector that I think is going to do well. That way I try to recover the money, because those dog stocks are not going to come up even if the market comes back up again. So that's the other thing I try to do in this kind of a situation. So let me leave you with that. I'm really gratified with the increasing number of subscriptions. We are almost close to touching 50. We are at 49. We just need one more for 50. And then we go further from there. And thanks for all the likes that you're giving, which motivates me to bring you contents like this. And my contents will only get better with more technology, and as I get more experience with the software and presentation styles. Please give your feedback on what you think should be improved and what you think are good and should be retained, so that further sessions will be of more interest to you. Bye for now. Take care.